as a reminder to those who don't know you as well as we do, you're in the real estate business, principally. So let's talk about real estate in the context of rates, right? Rates has everybody nervous, certainly had everybody nervous last week. But in real estate, rates aren't supposed to be that bad because if the economy is growing, and it is, you're supposed to be able to raise rents. So tell us about the balance between the rising financing cost and your pricing power.
Good morning, Erik. You dove in on the number one issue for all investors, not just real estate investors, is the direction of rates and competition for capital. So, yes, if you had your choice, you certainly would have higher rents, or higher rent growth is more important than interest rates. And if you think rents are going to go up 20, 30%, whether the 10-year goes from 3 to 3.5 doesn't matter. But on the margin for levered investors, for guys who are just buying cash flow, they certainly should impact prices. But there's two ways rates will go up. One is economic growth. And if there's economic growth, job growth, wage growth, I really like that scenario for real estate, especially for things like apartments, because people have more money in their bank accounts, they'll be able to pay more in rent. Businesses are expanding, absorbing office space, industrials being absorbed by companies. If rates rise because there's a buyer strike, and because we've become so undisciplined in our spend at the national level that we're printing more paper than there are buyers for, that's negative. That's bad. And what you saw last week was rates move very quickly into almost a vacuum, probably a bit destabilized by the Italian bond meltdown and signs of inflation, overheating economy here that would overheat and go negative. I think also the yield curve, the fact that short rates and long rates were flattening out, to me is a sign that I'm not thinking this is the only time that it doesn't signal a slowdown. I think this is likely to see a slowdown, not immediately. The economy is on fuego, but it should be because of all the spending. It'll roll over in 2020.
So on balance, right now, clearly we have a growing economy, rising revenues, expanding, the expanding bottom line, and
with a few holes.
Some wage growth, few holes.
Few holes.
But you think we're going to have a fiscal problem? Is that what you're getting at?
Yeah. You
do?
Well, I think one of the largest buyers of our bonds has been the Chinese, and at the moment we're not exactly pen pals. And I think there'll be a competition for capital. I mean, the deficit's rising rapidly, and thank God the economy is growing, because you can't spend $300 billion on top of a $1 trillion tax cut every other day. So I think in general, the economy and the real estate markets are very sound. People are nervous about runaway rates. The whole thing is sort of good for real estate in a strange way, because labor costs are rising, commodity prices are rising, steel prices rose dramatically with the tariffs. And so the cost of new construction is, because you're looking at pro formas and you're saying this doesn't work anymore. That's good for existing real estate.
Does that make you a seller?
Well, I would say we're on balance a net seller right now in the U.S. and a buyer in Europe. In the U.S. because the fiscal situation scares me on rates, and our policies towards our international partners worry me about buyers for our bonds. The deficit will end up close to $1 trillion next year, if not higher, $800 billion this year. And we're in a boom time. This is really unusual, right? So, yeah, we're really excited. We have a 3.5%, 3.7 unemployment rate, but it's coming at a price, a hidden price.
You're one of the first people I've heard to actually worry that the Chinese are going to exercise the nuclear option. Effectively
the nuclear option would be either
stop buying U.S. Treasuries.
Stop buying Treasuries or lower their stocks, but then it's only domestic people that could really buy. We saw some purchases by Belgium years past. That wasn't the Belgians, it was the Chinese through Belgium. So, I think they were a bigger force in the marketplace. Now, they'll have less dollars if there's less exports or imports. So.
You sold a lot of property in the past 6 months, haven't you?
Yeah, we've sold probably $5 or $6 billion of assets in the last 6 months, maybe more.
Will you do that again in the next 6 months?
No, we were weeding out the portfolio. We sold a bunch of apartments that we owned. We were the nation's second largest owner of apartments at 91,000. So we sold a couple billion of apartments. We sold a big office portfolio on the West Coast to Asian buyer. We sold a hotel company we built in the UK to a French buyer. And we've sold all of our Scandinavian exposure. So we're weeding through the portfolio and kind of just offensive defense, trying to lower the pricing is good today. Pricing is still attractive. And we've hit our target performance.
Is that also because there are some undisciplined buyers in the market?
Well, buyers are shifting. The Chinese obviously have left the table. We had a hotel we were selling to the Chinese, and it fell out because they didn't want to piss off the Chinese government, even though the money was coming out of another area. You've seen the Southeast Asians, the Singaporeans, and even money from Hong Kong that's offshore, and the Koreans participate in the market. Middle Eastern investors are kind of showing up. So I think, and domestic, I think you're seeing a return of the high net worths to the market, which are looking at this inflation pressures on the horizon and thinking real estate is a good place to park capital. On the other hand, you do have a lot of undisciplined money. You have hedge funds in the market that have maybe having trouble with their core business, and they are doing some crazy things.
Why buy in Europe with the overhang of Brexit and the threat?
I didn't say we were buying in the UK. In the UK,
and the
we
threat of
focus
something
on,
in Italy.
our focus in Europe is sort of continental Europe. We've been big investors in Norway and Sweden. We just were topped by a German property company buying an affordable housing company in Sweden. We just took control of a company and a German property developer. Why in Europe? Yields in Europe are very close to U.S. yields, really, 3.5%, 4%, 5%. But interest rates are substantially lower. And the 10-year German bond, last I checked, was like 60 basis points. Ours is 3.16, 3.18. So the spread between yields and property is wider and likely to stay wider. There's less pressure on rates in Europe than here. So we kind of think Europe is attractive. And it's harder to add supply in Europe than it is here.
You worried about Italy?
Yes and no. I'm worried about the economic, the union, the EU. I'm worried that when England leaves, that the Germans have to basically be the net supporter. The British, the Germans, and the French have been the net suppliers of credit to the sinning nations of the EU, and I wonder how long this will go on. And you have to put that against Merkel's situation, which took a turn for the worse. So I am generally a little nervous about Europe right now.
Here's a question,
at the political level.
A question for you about the business model. The largest alternative asset managers are putting a big emphasis on three things: scale, diversification, and permanent capital. Scale, because the bigger you are, the fewer competitors you have. Diversification, because you want to be able to, win the wallet share of the biggest institutions. And permanent capital, because you can hold assets through a cycle and create these fixed income substitutes. Right. You've got a permanent capital vehicle, but you don't have the scale and you don't have the diversification of some of those.
We're 64 billion. But
some of those other firms.
If you're asking me, would we like to be in other alternative businesses? Yes, like private equity, venture, and credit. Those are, and we sort of are in the credit business. And our public company, Starwood Property Trust, just bought
Property Trust, right?
Just bought GE's energy lending business, and we're looking at
deal,
other. Yeah, I hope it was a good deal. We'll see. We think so. We think it'll be a really good another cylinder for growth in the public company. And the analysts got confused because we're doing energy lending, but we want to withstand any cycle. And there may not be times to make real estate loans, and there are times to do energy loans that are not related to each other.
So you want to be in corporate private equity, you'd like to be in venture capital, you want to be in private credit more than you are right now?
Yeah, we're starting in venture. We're starting Starwood Ventures, and because we also have a real estate prop tech. There's all this real estate technology that we can apply to our own portfolio. For example, ways to handle security deposits in apartments that are internet enabled. It's a company called Rhino. There's all kinds of crazy companies coming up that are doing things. It's offensive and defensive. We have to know how we can be hurt and how we can be helped with new technologies in the property space.
So how do you solve those other problems?
I go merge with somebody or buy them. Yeah, or build them. Or take, we have over 400 investors, and we do manage 64 billion. We have a fairly sizable renewable energy business, equity. We're on a third fund. It was $1.25 billion. It's the third fund. The returns have been really good. We have an oil and gas business, kind of small, but very successful. And obviously, we have a hotel business and
how seriously are you thinking about a merger?
Oh, we get approached all the time. So maybe thinking
Is
about
it important to be above $100 billion? That's what the larger firms say. You know, that puts you in a different class.
Our last fund was $7.5 billion. Starwood Opportunity Fund, I think it's 11. And we've really done 14 funds. That's why I hesitated. But this is 11. We had no problem raising capital. $7.5 billion. My partner's like, we don't want more money, and we don't want to be forced to put money out. In our business, being private, we're not an asset gatherer. There'll be times when we shouldn't invest. And being public, and you're really talking to public companies, I mean, they have to keep up. They have the Lion King problem. Every time they harvest a deal, they got to match it the next year. And I don't like that. I don't think you want to sell and harvest every wine at its time. I don't really want the pressure of fee-driven growth. I think it's not me. I'd rather just do well for our clients over long periods of time and align our interests with theirs and sell anything when we think it's the right time to sell, not when we have to make quarterly earnings.
What about going public? What about some other kind of liquidity event like selling a GP stake?
I have a public company, Starwood Property Trust. We have sold 20% of our firm to a Neuberger Berman affiliate.
Guile, yes.
And that's allowed the company to have a balance sheet. So we went out and bought a property management company who manages 60,000 apartments now. And we're looking at buying other businesses, which basically, including starting another business, which you'll hear about shortly if we do it. And yes, we will use that money to seed a new vertical for the parent. And not because we need to, really, because I think I like being a sharpshooter. But it is, when we built our debt business, it helped our equity business. They kind of, in real estate. And I think having other ways to deploy capital, not having to force feed capital in any arm is a good thing. I mean, right now, our strategy is go slow. I mean, we want to see the midterms. We want to see Brexit. We'd like to see maybe some fashion of equilibrium in rates.